Before we start, nothing in this video is financial advice. This is education only. Please do your own research and consult a qualified professional before making any investment decision. Now, imagine checking your portfolio and seeing a market full of household names trading at prices not seen in years. That is Germany right now. The DAX is packed with global industrial giants selling at what look like bargain valuations. But the German economy is under real pressure. So the question every European investor is exploring is this a genuine bargain or a value trap in disguise? Let's find out. Germany is the largest economy in the Eurozone and the third largest in the world by some measures. For decades it was the engine of European growth, precision engineering, world-class exports, a rock-solid fiscal reputation. But that engine has been spluttering. 3 consecutive years of contraction or stagnation have shaken confidence in what was once seen as an unstoppable industrial machine. The root of Germany's pain goes back to the energy shock that followed Russia's invasion of Ukraine. Germany had been deeply reliant on cheap Russian natural gas to power its heavy industry, chemicals, steel, automotive manufacturing. When that gas was cut off, energy costs surged and energy-intensive businesses faced an existential question: can we still compete globally at these prices? Some factories scaled back, some relocated production elsewhere. Here is one piece of genuinely good news. German inflation has been falling faster than the broader Eurozone average. As of the latest readings, Germany sits at around 2.4%, below the euro area figure of 2.8%. That means German purchasing power is holding up slightly better than for its neighbors, and it gives the European Central Bank more room to keep cutting rates, which matters a lot for valuations. The European Central Bank has been cutting interest rates as inflation across the bloc cools. This is significant for stock investors because when rates fall, future company earnings are discounted at a lower rate, which mechanically pushes valuations higher. For a market like the DAX, which already looks cheap on several metrics, rate cuts can act as a meaningful tailwind. It does not fix the structural problems, but it changes the math. The broader European backdrop is one of modest, fragile recovery. The EU's GDP growth forecast for 2026 is around 1.1%. That is not exciting. It is barely above stall speed. For Germany specifically, the outlook is even more uncertain given its industrial exposure. A slow growth Europe means slow demand for German exports within the bloc, adding to the pressure from global competition. The DAX is Germany's flagship stock index, comprising 40 of the largest publicly listed companies. Names like Siemens, Volkswagen, Allianz, BASF, Mercedes-Benz and SAP site inside it. Crucially, the DAX is not a mirror of the German domestic economy. It is heavily export-oriented, with roughly 80% of revenues earned outside Germany. That is a double-edged sword. DAX companies are not fully at the mercy of Germany's sluggish domestic economy, but they are exposed to global trade slowdowns and currency swings. When demand softens in China, Germany's biggest single trading partner, it hits the DAX directly. Germany's relationship with China deserves its own spotlight. German automakers, Volkswagen, BMW, Mercedes, have historically generated a large share of their profits there. But Chinese domestic brands, especially electric vehicle makers, have rapidly gained share, and the premium German cars once commanded is being competed away. This is a structural shift, not a temporary dip. So why do some investors still see opportunity? Valuations. The DAX has been trading at price-to-earnings multiples that are meaningfully lower than its own historical averages and dramatically below the valuations you see in US equity markets. When quality companies sell cheap, patient investors who can tolerate short-term pain have historically done well. The question is always whether cheap is cheap for a good reason, or cheap because the story has permanently changed. German blue-chip companies have a strong tradition of paying dividends, and many have maintained or even grown payments despite struggling share prices. For income-focused investors, that means being paid to wait for a recovery. That said, dividends are never guaranteed. Companies under profit pressure can and do cut them. Here is the full picture laid out cleanly. The bull case rests on cheap valuations, falling inflation, ECB rate cuts, and the long-term durability of German industrial know-how. The bear case points to structural energy cost disadvantages, the China EV disruption, weak domestic demand, and an economy that has struggled to adapt quickly. Both cases are real. This is not a one-sided story. One genuinely new development is that Germany has loosened its famous debt brake, the constitutional rule that constrained government borrowing for years. That unlocks substantial new spending on defense, infrastructure, and the energy transition. German defense and industrial conglomerates stand to benefit from higher NATO spending, while major rail, grid, and digital infrastructure investment could deliver multi-year contracts to engineering firms. These are not speculative themes. They are policy decisions already being funded. The automotive sector is perhaps the most complex piece of the DAX puzzle. Volkswagen, BMW, and Mercedes-Benz are all executing enormous, expensive transitions from combustion engines to electric vehicles, requiring massive capital spending at exactly the moment revenue and margins are under pressure. Getting this right is existential, both for these companies and for the hundreds of thousands of German workers in the supply chain. The chemical sector tells a similar story. BASF, one of the world's largest chemical producers, is deeply exposed to energy input costs. When gas prices spiked, it was among the most visibly affected, announcing plant closures and relocating some production abroad. The question for investors is whether these companies can structurally cut their cost base or are locked into a permanent disadvantage in Germany. Not every DAX company is an industrial giant wrestling with energy costs. SAP, Europe's largest software company, is a very different kind of business. It sells enterprise software globally, benefits from the shift to cloud computing, and has much lower sensitivity to German energy prices or Chinese consumer spending. SAP's strong performance has been a meaningful contributor to DAX returns in recent periods, a reminder that the index contains real diversity. As a European investor, you also need to think about currency. When the euro weakens against the dollar or yuan, German exporters become more competitive abroad, but a weaker euro also makes imported energy and materials pricier. For investors outside the Eurozone, currency moves can meaningfully amplify or dampen your returns from DAX exposure. If you want exposure to Germany, the most straightforward route for retail investors is through a UCITS-compliant DAX ETF. These are widely available on major European brokerages, low cost, and give you broad diversification across 40 companies in a single trade. Alternatively, you could pick individual stocks if you have a specific conviction, perhaps overweighting SAP or underweighting automakers. You could also get Germany exposure through a broader European equity fund, where it typically carries a significant weight. A note on position sizing. This matters enormously with a single country play. Germany carries specific risks that a broader European or global fund would smooth out. Think carefully about what percentage of your portfolio you are committing and whether you are comfortable with the full range of outcomes. The upside could be meaningful, so could the downside. History offers some perspective. Germany faced enormous disruption after reunification in the 1990s and was called the sick man of Europe in the early 2000s, before a decade of reforms turned it into one of the strongest economies in the world. That does not guarantee the same turnaround this time, but writing Germany off has been wrong before. The risks worth watching most closely: global trade tensions and tariffs that could hurt export revenues, any reversal in energy price trends, German political stability and the speed of reform, and whether legacy German automakers can keep pace with Chinese and US EV competition. None of these are deal breakers alone. Together, they are a genuinely complex risk picture. The investors most likely to do well in Germany are probably the patient ones, those with a 3 to 5 year horizon who can hold through further volatility and wait for the reform cycle and rate tailwinds to work through the economy. Trying to time the exact bottom of a structural economic adjustment is notoriously difficult, but paying a low price for quality assets and waiting for fundamentals to recover is a strategy with a long track record. So, crisis or opportunity? Honestly, it is both, simultaneously. The crisis is real. Germany's industrial model is under structural stress, energy costs remain elevated versus pre-shock levels, and China exposure is a genuine headwind. The opportunity is also real. Valuations are low, inflation is cooling, rate cuts are underway, and fiscal policy has shifted meaningfully. Whether this is the best buying opportunity in a decade depends entirely on what happens next, and nobody knows that with certainty. Thank you for watching. If you found this useful, please like, subscribe, and hit the notification bell. We publish new episodes every week covering European markets, valuations, and investment themes. Our free newsletter is in the description with additional research and charts. And remember, everything in this video is education, not financial advice. Always do your own research. I am the European Investor. See you in the next one.